You with Newsfeed, I'm Stephen Curtis. Well, let's start with reaction then to that decision by the Monetary Policy Committee of the Reserve Bank to hike interest rates by 25 basis points, in other words, 0.25%. With me, our business editor, Xolani Mbanjwa, joined now by the chief economist at Alexander Forbes, Isaah Mhlanga. And Isaah, good afternoon to you. Look, no one can be surprised by this decision. It's still a big decision to make when you look at where our economy is.
Indeed, I am surprised really, because if I look at the inflation projections which the SARB put up itself, are only 10 basis points higher across the board from 2021 out to 2023, and we still have inflation right around 4.5%, which is the midpoint in 2025. If you look at the drivers of inflation, hardly changed, and it seems to me it's more about anchoring inflation expectations around 4.5%, which they haven't changed. So it's a bit of a surprise, particularly to me, but if you look at consensus, there were some colleagues in the industry that expected a change in interest rates. But on the basis of inflation and inflation forecast, it doesn't really align quite well, given that there wasn't much of a change in terms of the inflation forecast.
Isaah, I was under the impression that the MPC does not consider inflation when it makes its decision and when it's meeting over those 2 days.
It considers inflation. Remember, the SARB is an inflation targeter, but they do target the forecasted inflation. Historical inflation doesn't really matter much. It is what they project over the next 2 years that matters. But if you look at their forecast, 4.3% in 2022, 4.6% in 2023, and 4.5% in 2024. That is roughly around the midpoint of where they want inflation expectations to be anchored at. So it's really not much of a big change from the previous forecast which they had at the last MPC.
How do you think the markets are likely to react from this news? Because we heard that question coming through about the rand reacting negatively to this announcement. What do you see? How do you see the market reacting?
60% or more of rand volatility are driven by external factors, not what happens locally. So to that extent, it is what happens with the U.S. Fed. It is what happens with commodity prices, but also what happens in other emerging markets that is going to drive much of the volatility or even the movement in the currency. What they have done now, given that market expectations were roughly divided, it is in line with what a majority of economists and market analysts has expected. So I wouldn't expect a significant reaction to this particular move. Only the global factors are going to matter more, which is why I think the SARB opted to hike rates, because they expect those global factors to lead to a depreciating currency, and also which might de-anchor inflation expectations going forward.
So, Isaah, I mean, the next question, of course, is we can expect really the start of a cycle of hikes. In other words, we're expecting now interest rates to go up and up and up very, very slowly. I mean, I understand the point that you make. You clearly believe that there was space to maybe wait a little bit longer. This is then going to actually slow the economy. I mean, to listen to the Reserve Bank governor, you get a picture of how bad the economy really is. Do you think this is a misjudgment then?
Look, high inflation hits the poor, and to the extent that the SARB wants to control potential de-anchoring of inflation expectations, which have impact in terms of wage settlements in the economy, it is the right decisions. We had thought perhaps in January or even in March, which is only 3 to 4 months difference. So it's not a substantial difference in terms of our expectations. But if you look in terms of the growth sacrifice ratio, meaning how much growth do we sacrifice by hiking interest rates by 25 basis points, you can't even see it in the rounding numbers of growth forecasts. So it's not going to have a significant impact. What impacts economic growth to a large extent at this point in time is things like load shedding that we have, which has significant weight in terms of economic activity across industry. Those are some of the things that would need to be fixed. Monetary policy impact over the short term, very minimal. 25 basis points, very minimal. It's unlikely to have a significant dent.
Let's talk about the economic growth forecast for 2021. We heard from the Minister of Finance last week. I think it was 5.1%. This 5.2% that I think was announced now by the Reserve Bank Governor is not too far from that. What do you make of these forecasts? Have they been spot on in the past, or have they been too ambitious?
2021 economic growth forecast is less of a debating point. We are already in November, 1 month left. All the impact of the load shedding in the third quarter of this year are now incorporated. Also impact of load shedding in the fourth quarter also already incorporated. So it's not much of a debate. Economic growth is going to be robust this year for the full year as a whole. What is a risk is 2022 and 2023. An economic growth forecast of less than 2% for an economy with such high unemployment rates is really very low. It just says the economic reforms that are being implemented are not being implemented fast enough to lift that economic growth. And as a result, the economy will remain in crisis, and the economy will remain with very low levels of job growth. That means unemployment rate will continue to remain very high. That's the risk that we run, and it's really an economy that is in deep crisis that needs faster economic reforms.
I think the way they put it in the briefing, Isaah, was economic growth is expected to align with the low rate of potential growth. And when you talk about potential growth, what you mean is how much our economy could grow by. And it keeps coming back to the same things, doesn't it? It comes back to the energy crisis. It comes back to the lack of structural reform in the economy. Even though we had a medium-term budget policy statement last week and there were promises of structural reform, March seems to be a big month for issues around Transnet and private railways, private cargo being transported on Transnet railways and all the rest. I still don't see anyone thinking, well, we're going to increase that rate of potential growth. In other words, it comes back to the same thing, what you and I, Xolani, have been discussing for a decade. No proper structural reform.
Indeed, if you are an institution that has to make forecasts of economic growth that depend on the government's ability to implement these reforms, looking at the history of implementation, you will be damned to actually believe they're going to implement fast and lift your economic growth forecast that impact the decisions you make today. So you produce your forecast on the basis of existing, economic policy. And if you do get economic reforms being implemented, you can then update your economic growth forecast. So it is the correct decisions from both the National Treasury and the South African Reserve Bank today to make sure that those economic forecasts are not overly optimistic given the poor implementation of economic reforms historically. So we will have to wait to see the implementation. And by the way, the MTBPS has a number of those economic reforms being implemented from March 2022 until November 2022. So we'll have to wait until then. That's when we can actually update our economic growth potential rate once we see the implemented economic reforms. For now, it makes sense to keep them at the pace of existing economic policy.
Isaah, the governor said we are seeing a weaker currency, escalating wage demands that present risks, but when it comes to investor confidence, it is a faster vaccination rollout, load shedding that are actually uppermost mind to investors. Talk to us about those, because it's something that we've discussed over and over again about the importance of fixing the energy supply in this country and making sure that the vaccination rollout is actually done with speed.
Indeed, if I were to start with the expectations on the currency, it's not just a South Africa story. It is an emerging market story, given that the major central banks globally are now reducing the pace of their asset purchases, which have supported risk appetite, which benefited emerging market currency. The Fed is going to start to withdraw that 15 billion per month over the next couple of months, which is going to be quite important. The UK Bank of England is also expected to start thinking about hiking interest rates, and that is a global trend. Already we have seen some 21 major emerging market economies hiking interest rates year to date, but also for them, because inflation have actually increased way beyond their inflation targets. But if coming back to the issues of lack of energy, we have been talking about lack of energy for the last decade, yet we are still battling with the same problem today. It is going to be difficult to convince any major business or investor offshore to come and sink a mining shaft without sufficient energy, or even to come and establish a manufacturing plant of some products without security of energy. That is something that we need to get right before we can even think about improvement in terms of business confidence or even attracting foreign direct investment. If the local investors or business people are not convinced, it becomes difficult to see why a foreign investor is going to be convinced.
Isaah Mhlanga, thanks very much indeed. Do appreciate it. I'm not going to say anything about the load shedding indicators that may or may not be on the screen. Isaah Mhlanga is the chief economist at Alexander Forbes. Xolani Mbanjwa, well, we call him business editor, but he's really our chief economist. We'll have more reaction to this decision as we go through the afternoon.